Welcome to Web3 Watchdogs, the podcast that takes a deep dive into the world of Web3 security, compliance, and risk. Join Michael Pearl as he interviews executives from across the Web3 industry to uncover the challenges and opportunities of this rapidly evolving space. Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.
Hello, everyone, and welcome to the Web3 Watchdogs, the podcast that focuses on everything security, compliance, risk, fraud, scam, and everything in between. And before we dive in, remember to subscribe, to rate us 5 stars, to comment, to like, and to engage with us with any way you find suit. We are live on all the podcast platforms and on YouTube. And today we have with us Eitan Katz. Eitan is the co-founder and the CEO of Kima. I guess you heard the name before, but we're going to dive in and we're going to hear about what Kima are doing and the security measures, the compliance measures that they are implementing in this very interesting and innovative platform. So Eitan, thank you so much for joining.
Thank you for having me.
So please tell us about yourself. You have such an extensive background. I decided to just let you present it and then we can dive into the questions.
Sure, definitely. So real pleasure to be here today. A little bit about myself. So you can see by my gray hair, I've been around for a while. Started my career over 3 decades ago as a software engineer. I spent many years in the tech industry in a variety of roles, doing product management, marketing, services, you name it. I spent a couple of years with HP, established the global incubator for the corporate, created an innovation program from scratch and a very systematic approach. But the real passion since 2013 was around blockchain and cryptocurrencies. I stumbled and read the Nakamoto white paper back then in 2013. And that was a really mind-blowing experience for me because I saw the potential innovation. It was very early, but I saw the nexus of innovations, which is very rare. There was the financial aspect, there was the technological aspect, and the potential social impact of these changes. So I started diving in, and with a couple of friends, we created what became the first MPC Bitcoin wallet. Back in 2013, 14, it was an open source project, not a startup. We did it as a community project. It was a side project for everyone, but that was
How is
really
it called, this project?
AEGIS. Very early days, we created a very primitive solution that split the management of the private key of the wallets into 2 parties. One of them was a bracelet with an NFC chip that we created. I went to 3D print the bracelet, so and only in proximity you could sign a transaction. Really an original idea that later became very prevalent, but this is I think was the best back then in 2014 was the safest wallet that existed for Bitcoin. After that, I spent a few years doing some other stuff in the space. I was involved in the arbitrage and trading startup, and since 21 all into Kima and interoperability in the space.
Very interesting. So you're one of the OGs of the industry since 2013, very early on.
Yes.
Nice. So let's talk about Kima. So your goal, basically, as you stated, your mission statement is to fix the interoperability problem. So can you please explain what the problem is and why did you decide to focus on that? Why did it hamper the progress of the industry?
So, as they say, it's always best to scratch your own itch. because then you really know and feel the problem. So the history is really starts in a completely different project that myself and the other co-founders were part of. We back in 21, when in the previous bull run, we thought, being veterans of the industry, we knew that after a bull run comes a bear market, and it's important to apply some risk management strategies into these bull run strategies. So we created a toolkit of automated hedging strategies for hedge funds, for family offices. Pretty complex stuff, but one of the potential customers came from the Solana DeFi ecosystem. They really like the idea that they will be able to protect the funds of their investors from volatility. But we needed the derivatives. The strategies were based on derivatives, and there were no derivatives back in 21 in the Solana ecosystem. So we needed to use derivatives and financial instruments, both in the Ethereum ecosystem and on centralized exchanges like Deribit. And guess what? It was impossible really to interconnect these instruments to a Solana application. So we started looking at solutions. We didn't like what we saw. We saw this is a cybersecurity related podcast, and the major concern was around security because and we all heard back then and ever since about the hacks to multiple bridges and the projects that try to do similar things. The other problem was that there was nothing that really connected a centralized exchange with the DeFi ecosystem. So we started designing a solution ourselves, and eventually we decided that we're actually solving a way bigger problem in a way more original manner. So we decided to go all in and solve the interoperability problem. So if I have to state the mission here, it's not so much about cross-chain interoperability. It's more about interoperability across any type of ecosystem. And that's really what one of the things that make Kima stand out. Our definition of the problem is way broader than let's bridge USDC from Solana to Ethereum. We're looking at the financial system and other ecosystems that are completely disparate. Blockchains cannot communicate with each other, definitely not communicate with the rest of the world. And this is the problem that we're solving. We're creating a blockchain as opposed to intermediaries that solve today these problems that can settle transactions across any type of asset. We're completely agnostic, any chain, but also connecting directly to bank accounts and facilitating transactions across traditional finance and the new DeFi.
Perhaps it's a good time to explain. I know that you're talking about the interoperability in the broader sense, and we're going to dive into that, and we're going to even talk about your connection to the fiat funds and obviously to centralized exchanges, as you've mentioned. But perhaps let's zoom in on the existing solutions. So we all know bridges, and obviously the average person asks himself, okay, so we have a bridge. What's the problem with it? Why can't we just use a bridge? Why do we need Kima? Again, even in the more narrow sense, with respect to just going across chains, why do we need another solution? What's the problem with the bridges?
Yeah, so there are several types of bridges. We need to really, they're not all built the same way, but there are some common practices. Let's call it this way. So the problem with the bridge that bridges solve is the fact that if we have money on one blockchain, these assets, they have a native implementation, native smart contracts. Those are native assets. We may call the asset the same name. We can call it USDT on Tron and USDT on Ethereum, but in fact, those are completely different assets. They may try to peg to the same underlying asset. They may have an identical or similar value, but they are different technical implementation. The USDT on Tron is nothing like the USDT on Ethereum. So, and blockchains by design, in order to preserve the security, they don't trust anything that was not natively validated by the validators of the blockchain. That's a design principle. The downside is that they cannot communicate, they cannot trust anything that is coming from outside of this ecosystem. So the outcome, the result is silos of data, silos of compute power, and silos of liquidity, silos of value. Now, the bridges are trying to enable the transfer of these completely different assets between these ecosystems. And since those are different assets, there are two main practices to solve the problem. One is a lock and mint, which means that the original native asset is locked at the source, and a smart contract mints a synthetic representation of the asset on the other side. So now,
Basically, a pegged coin that is pegged to the original native asset.
correct. So the sole existence of the synthetic asset, the wrapped token at the destination, depends on the existence of the locked token. And as long as you work with a synthetic token, everything is okay, and you can always go back and redeem your native token. So the synthetic one will be burned, and you will get the native asset. The second practice is similar but different. It's burn and mint, which means that the original token will always be burned and a new one will be minted. The problem is with the mint part, because this is not a native token. It's someone wrote a smart contract that mints something new out of thin air with the trust that something is locked at the other end. It's like the best metaphor I have is that if I want to send you money, I will fax you an image of $100 bill, and I can promise you that I'm putting my original bill in the safe. I will never use it, and you should now go to the grocery store and buy with this image of a bill, promising everyone that it is based on a real $100 in someone's safe. Now, that could be the case, but the problem is that someone can break into the safe. That's one problem. The other problem is that someone can now start printing new images of the bill and copy the bill. And that's actually what happened quite a few times with bridges that were hacked. So the smart contract that either stored the original asset or the one that minted the new asset were exploited, were hacked. The private key of the smart contract was compromised. And the hacker started printing free money. That's basically what stood behind the big wormhole hack and the Ronin hack. Those are the big names with the big amounts, but even smaller hacks. So this is one type of.
Yeah, maybe another aspect, even if they're not hacked, correct me if I'm wrong, there are many different impersonators of existing tokens, especially of synthetic tokens. So you can have, let's say, the Kima token or BNB token with many, many different variations and with basically the same name. And you have to go back to the original hash of the smart contract to actually see if that's the original token or the copy, and oftentimes you don't even know it. So even without going to the length of actually hacking into the system, you can gain much just from tricking it.
Absolutely. I can create now a token named USDC, and no one stops me from doing it. And I can start sending it to people. They will get into the wallet a token named USDC, and they will assume that it's the same USDC. But there's no connection between these two USDC tokens. So the only way is really to go into the smart contract that created it and see who owns it. But even then, that's another problem, because the owner, you have to trust the team that created the smart contract. How do you know that this team is really owning now the private key? Maybe someone compromised the private key and they changed even the code. So in the USDC that you're holding, there's code that says that at any point in time, the hacker that minted this token can now take it away from your wallet. It's very easy to do with smart contracts, right? So that's part of the problem, because on one end we say code is law, everything is open source, you can just check everything. I'm yet to meet someone that before every transaction goes to read the code to make sure that it's really what they think this smart contract is actually doing from the right owner without being exploited with the ownership of the private key.
Yeah, for sure. So now that we understand better what bridges are and how they work and what are their problems, can you please explain how Kima works? What's different about your infrastructure, and how do you aim to make this whole cross-chain experience better?
So at day one, when we started thinking about a solution, the underlying assumption was, let's build something that doesn't just mitigate the problem, but makes it go away. At least this problem, many problems, but at least this one. We asked ourselves, what if there would be a bridging solution, an interoperability protocol that doesn't use smart contracts? What if we create something else that eliminates at least that attack vector, the smart contract and the trust assumption about the team and the ownership of the private keys for the smart contracts? So, the hacks that we see in this space, unless we're talking about 51% attacks, they all happen at the smart contract level, not the blockchain level. And the private keys, how you store the private keys, who has them, who has control over them, is it a multi-sig? So it's either the keys or the smart contracts. And I think that, don't get me wrong, I think that smart contract is a fantastic innovation. The problem is, are they safe enough or trusted enough to store funds? So this is why we have banks in the world, right? Because I can keep all my money in the safe at home, but it's not safe enough. And we need something that specializes in keeping our money. This is why banks were created. So we designed a solution that embeds all the functionality of the bridging part inside the blockchain instead of smart contracts. Again, going after the notion that blockchains are way more difficult to hack than smart contracts. So there's no magic. The code needs to live somewhere. So in our case, the code lives in the validator nodes, and there it lives in a trusted execution environment. So we have multiple layers of security. We use TEE. In our case, it's the Intel SGX, the TEE, Trusted Execution Environment on the Intel CPUs. And we use instead of using smart contracts to hold the funds, we use EOAs. We use externally owned accounts, where the key is an MPC. So we break down the key for every one of these EOAs in the ecosystems that we support. And the validators, we use TSS in order to sign collectively withdrawal transactions. So a Kima transaction is always a deposit and a withdrawal. So there's no mint. It's always a withdrawal of native tokens. We have a network of EOAs which function as liquidity pools. So there's a local deposit and a local withdrawal. But the owners, all the EOAs are secured, instead of smart contracts, they're secured by a blockchain. So in order to break our bridging capability, we're not an application, we're not a bridge, we're the infrastructure. But to break it, you need to hack into 2/3 of the validator nodes, and then break into the Intel SGX part, which lives on a hardware of the CPU, basically. So you need an electronic microscope to get access to the shard, and then do this to 2/3 of the validators and collectively sign withdrawal transactions to steal the funds.
I have to ask, I think I know the answer, but maybe just to clarify, how is it different from layer zero approaches of different sorts, right? Because at the end of the day, if you look at it at a very superficial way, it sounds the same way, right? It sounds kind of the same because you have a blockchain that connects between blockchains and the interoperability is at the blockchain level. So how does Kima differ from that?
Yeah, so in the case of layer zero, the messages are being sent by relayers. So those are machines of people that they run the machine in order to send the messages between the ecosystems. But the funds, they are kept by a smart contract. Every other solution, layer zero, Chainlink, Axelar, you name it, every other solution uses, at the end of the day, smart contracts to receive funds and send them. So layer zero indeed it doesn't mint new synthetic tokens. The others do. Axelar, they have their own AXL USD, which is the bridging currency that is getting minted by smart contracts. But the bottom line is that every other solution uses smart contracts to hold the funds on both ends, whether they mint synthetic ones or just to hold them. And we have, this is the unique approach that we came up with when we started. We have a patent pending for it. And this really makes our architecture.
Very interesting. And can you give us some details about how it works? Is it essentially a retail platform that anyone can access, or do you have any kind of B2B partnerships that are enabling it?
Yeah, so we're a protocol. We're a blockchain. Kima is also a blockchain. We wanted independence. We didn't want any dependency on any other ecosystem because we wanted to be, the Switzerland of the blockchains. We just wanted to facilitate the money transfer. So we have our own L1. And then there are the EOAs, which hold the funds on every ecosystem or every chain. So we have an EOA for USDC on Ethereum and for USDT, and then Tron, and then Solana, and Optimism, and so on and so forth. By the way, we are now adding support for Bitcoin as well. So we have the blockchain with the validators, we have the EOAs. We have liquidity providers that are part of the ecosystem. They provide liquidity into the EOAs so funds can be withdrawn at the destination of this transfer. And we provide an SDK. So applications, we're a complete B2B solution. Applications can utilize the SDK or use the APIs in order to send either messages or funds between those ecosystems. So there's a Kima transaction. You need to provide the parameters, and once the transaction gets invoked, at the source, the holder of the funds will be asked by the wallet to approve the transaction. So Kima pulls the funds from the wallet at the source and stores it in the EOA at the source chain. The validators wait for finality to make sure that the funds indeed were pulled and stored. And then and only then, they will collectively sign a withdrawal transaction to send funds from the EOA at the destination to the target wallet. So
that's probably the most sensitive part, right? These two transactions of deposit and withdrawal.
Yeah, so deposit is really, we need to make sure that the withdrawal happens only if and when the deposit is irreversible. So this is the part of the validators. They use light clients in order to make sure that the state of the source chain has changed. And they're waiting for finality. Every chain, they have to wait to a different number of confirmations. So it is not reversible. Once that happens, then comes the second part, which is the signature part. That's where we use TSS to sign the withdrawal transaction. This is the sensitive part because hackers will try to imitate that part to steal the funds from the liquidity pool.
Yeah, I can say from a personal experience, working with bridges and depositing and then waiting to see it on the scanner of the other side. It's one of the most sensitive moments and really nerve-breaking moments to see, until you actually see the balance on the other side.
Right. So in our case, first you can always see the status because those are two transactions on two different blockchains. So we always provide the hash. You can go and see what's the status of that transaction. And until the moment that the withdrawal transaction is signed, it is still reversible. So if for some reason the withdrawal transaction doesn't take place, the deposit will be reversed because we pulled the funds, so we can also send them back.
I talked to a lot of projects, both as part of the podcast and in my personal life, and usually when you ask them about security, honestly, it's prioritized. Number 5, number 6 after marketing, sales, anything else. And even then, I'm quite sure that they're exaggerating because they don't really think about the security element all day long. How would you prioritize it in Kima? I'm guessing that this is your claim to fame, essentially, right?
Yeah, this is where we started. We started from a security angle. So again, the whole reason of being for Kima was the vulnerabilities that we saw in existing solutions with the way smart contracts are being built and how they are being managed and the private keys. So absolutely, this is the number one priority. From that, a few byproducts were created. So by removing the attack vector of smart contracts, a beautiful thing happened. We also removed the dependency on the smart contract technology, which again makes us unique because now, if we're not dependent on smart contracts, we can work with Bitcoin, which doesn't have any smart contracts. We can work with bank accounts. We can work with enterprise applications with Web2 API because we're completely agnostic. We're not dependent on smart contracts.
Can you elaborate on that? And we mentioned this earlier about working with bank accounts and in general with fiat money. How does it work? Because when you explain the whole process of deposit and withdrawal when it comes to blockchains, you can imagine how it works. But when you're dealing with a Web2 fiat entity, it's probably much, much more complicated.
Yes and no. So it is complicated from an operational perspective, compliance, so we can touch those. But from a technical perspective, it's pretty similar because of the way the architecture was built. So I described it's always best to describe with hands. So we have the EOAs on multiple ecosystems holding multiple types of currencies, and there's always a deposit and a withdrawal. Same happens with the bank account. So the moment we create a connector that the validators use in order to communicate, just as they communicate with the blockchain through a light client, they can communicate with another box which has access through API to a bank account. So that's
So
all
it's kind of like an oracle, so to speak.
So I don't like the term oracle because it's a bit misleading. I come from enterprise software. We used to call those adapters and connectors way before the term oracle was minted. It's an adapter. Why? Because it's not only for reading data, it's also for writing, signing transactions. So if there's an API, every bank that provides APIs has an API to send funds, right? To withdraw funds, send funds. So now it becomes a matter of security. How can we avoid impersonation that someone will try to send funds from a bank account to their own bank account somewhere else? And this is where the security architecture of Kima comes into play because this is, again, we have TSS. So we have multiple validators. Each one does the operations separately. They need to agree, they need to reach a consensus and collectively sign the transaction using TSS. So the security here is in the actual distribution of the role. So it's not just one validator. We have multiple validators, and they need the threshold to sign a withdrawal transaction from a bank account as well. So we apply the same concept of liquidity pools. And when I talk to banks and I I try not to use the term liquidity pool, but sometimes I do, and I see how the faces change. Liquidity pool, that's money commingling. That's a bad thing.
Yeah,
So
also from a regulatory perspective, compliance perspective, pools
correct.
are considered, depends
Yeah.
on the jurisdiction, but it has a bad reputation, so to speak.
Yes. So they have a nice term. They call it an omnibus account. That's an account that is managed on behalf of someone else. So we apply the same concept of distribution also to the traditional banking system. So we create a network of service providers that are licensed locally in every jurisdiction that they work. They are licensed to hold funds, be custodian of funds, and also send them in and out. So instead of obtaining licenses, we're a blockchain. Blockchain cannot get a license from a government. So we apply the same concept of the network of EOAs also to a network of service providers. Each one manages a bank account. They have the license locally, and they just provide the validators the API access. We build a connector. So every jurisdiction that has a connector gets added to the big network, this ecosystem that we're building. So we start in Europe. We have a Spanish provider. They provide us access to a Spanish bank account, which gives us access to SEPA and credit card transactions across Europe. So that's very convenient. And this is a network. This is a mesh architecture. So everything that we have, Bitcoin, Ethereum, Solana, Optimism, Arbitrum, all of these get now connected to a bank account in Europe. And now Kima functions as a settlement layer that can move euros to stable euros, and stable euros to euros, and dollars to USDC, USDT, and vice versa in a single transaction without the intermediary that today is needed to do the on-ramp offer.
Very interesting. I'm just curious, and maybe I'm missing something, but given the fact that let's call them pools just for the sake of simplicity. So you have different pools with different assets in them. What happens if the flow of funds is only in one direction, right? So don't you have a pool that is congested with huge amounts of, I don't know, USDC, and then again you have lack of liquidity in another pool?
Right. Absolutely. Yes. This is the problem with when you try to balance supply and demand, sometimes there's an imbalance. So we did what Uber did. Uber has a network of cab drivers. If you try to get an Uber in Manhattan at New Year's Eve, that will be very, very difficult, right? Because there's a lot of demand, but very little supply, relatively speaking. So what does Uber do? They hike the price. So there's a surge in price, which brings in more supply. Now, more drivers are incentivized to bring the supply to address the demand. That's exactly what we're doing. We provide the liquidity providers, they get 50% of the fees that we collect. Now, if there is a pool with higher demand for withdrawing funds, the level of liquidity will go down immediately and automatically. The rewards will get bumped up, exactly like with Uber. It's algorithmically done. So liquidity providers will be incentivized to either add more liquidity there or move their liquidity from the pools with too much liquidity, with excessive liquidity, to the pool with higher demand.
Yeah, that makes sense a lot. Is it's actually more simple than you would think, right? I mean, at the end of the day, supply and demand and incentives. I'm sure that on the technical level and on the financial level, it's much more complicated, but it's very very commonsensical. So I wanted to ask you. So you've mentioned quite a few times the problems, especially with respect to security, that smart contracts have. I'm quite amazed to see how protocols, especially smart contract rich protocols, right? That have quite a few smart contracts, do not utilize the most basic security measures. The concept of, we're audited, it's more than enough is, I mean, we all understand that it doesn't work, and nowadays you have measures like real-time monitoring, and even simulations and preemptive preventions. What's your take on that? If you were to build a project that is based on smart contracts, how would you go about it with respect to security?
Yeah, so again, I'm going back to my background. I spent a few years on IT operations systems. So part of my specialty is in monitoring systems, not of smart contracts, of IT systems, of computer systems. Now, the sheer thought of building something and then deploying it, relying on someone to audit the code, and not doing more than that, not testing it through all the available testing options and then monitoring it, that is really, I have no explanation other than lack of experience. Now, what the IT and enterprise software industry learned from experience over decades, I think this is a maturity phase that we'll have to go through, because people, they like building stuff. It's easy to deploy it. There are no, again, if we take, let's take a bank. Okay, if it's a DeFi protocol, the security measures should be like a bank. There's no bank in the world that will allow someone that wrote a single line of code to deploy it before it went through a huge process, right? You would never deploy an external system by another vendor without really understanding what it does. Open source is not a big advantage there. There's a process for maintenance, a process for uploading new versions, and then comes monitoring. So all these practices that you're referring to, we have them already. We don't need to reinvent them. We need to reapply them to this industry, to this technological stack. And I'm really amazed when I read about these hacks and, the very basic practices of how to protect your keys, how to make sure that code that someone just changed one line of code and then they deployed it. And it's a one line of code. No need to now pay for an audit. No need to really monitor. No need to put it into a staging environment first. So there are so many practices that can be applied. And this is really amazing. I think the industry will not be able to mature before going through this maturity level of these practices of security.
Yeah, if you think about it kind of in a philosophical way, auditing is essentially a static activity, right? You check something once and then you let it go. But in essence, this industry, and especially the hacking industry, which is an industry of its own, it's very, fluid, very proactive, rapidly changing dynamic. And whatever seemed right to you based on your previous experience might not be right in 2 days when there is, a new technology, a new approach to how to infiltrate systems. So that's why you need something continuous and something real time to actually protect the system.
Absolutely. And I completely agree. So static analysis and then dynamic analysis, the practices of the hackers change, environments change, things that since everything is composable, so you rely on some other things. You use now ChatGPT, you use a code that you took from somewhere else. And it's not realistic to assume that with all these bits and pieces and snippets of code taken from so many places, that everything will just be okay if someone just audited the code.
Definitely. So we're moving towards the end of the talk, but I would like to ask you just one question that seems kind of interesting after everything that you've described with respect to the transfer of value and so on. So we see a trend in the centralized exchanges and in the CeFi world in general, where gradually you have more and more compliance restrictions and compliance practices that are crawling inside, right? So KYC, for instance, like 2 or 3 years ago, most exchanges didn't even have that, right? Right now, KYC is a commodity. It's something that is a standard for everyone. Right now, the trend that we see in the CeFi space is more towards traceability, AML practices, things of that sort. Can this be implemented in the DeFi space? And especially when you're talking about, cross-chain, cross-token, cross-platform, How do you view that? Because eventually the regulators are starting to push the system towards that direction. The question is, how can we actually, apply that to the DeFi space?
Yeah, so the simple answer is yes, absolutely. I think that there's no other way, but it's not all or nothing. So let's take KYC, for instance. KYC in DeFi is not mandatory unless you touch fiat, at least for now. So that might change. Stablecoins might be considered just as fiat. So maybe you would not need to do KYC if you just move one meme coin to another. But if you use stablecoins, especially if stablecoins will become regulated currencies in various jurisdictions like they do in Europe, probably that will happen in some sort in the US, especially if they're not going after a CBDC. So there's no question that digital currencies will become part of the mainstream financial system. And if that is going to happen, we will see more mandatory checks. So KYC is one, AML, KYT, know your transaction. So to know whether it's coming or going to some kind of sanctioned address. By the way, we implemented this in Kima. So today there's a way to, if you're an application, you want to make sure that you will not be used to wash or launder funds from hackers, from terrorists. So every Kima transaction can block sanctioned addresses. This is why we embedded this capability, because I think that it's coming. It will happen in various cadence and pace and in various jurisdictions, but it's coming. So at the end of the day, if Europe and the US will decide that that's what they want to do, they will do. So I think that as DeFi evolves and becomes more mainstream, we will see more regulation, more compliance, which is not necessarily a bad thing. It's a matter of philosophy and almost religion. But that's the trade-off between adoption and less quote unquote freedom. Although I think there will always be some kind of a fringe or some kind of applications that will not use stablecoin, will not use fiat, will use tokens and you will be able to maintain privacy, maintain anonymity, maintain control in this fringe DeFi. But the mainstream DeFi with the mainstream stablecoins, I think this is where they're going.
Yeah, I totally agree with that. I think that we will see much more interoperability, so to speak, between the stablecoins and the regular USD or euro, especially now with the new administration in the US. I think that we will see some strides towards that direction. So this will definitely require some more robust compliance practices. I totally agree on that. Eitan, thank you so much. That's all the time that we have for today, but it was fascinating and really looking forward to see what Kima are doing. Where can we find more information on Kima, about what you're writing and saying?
Yeah, so all social media. So our website, kima.network, and kima.finance is more of the financial institutionalized angle of Kima. Our social media, that means we're very active on Twitter, LinkedIn. We have a Medium articles that we post, and Telegram and Discord. So I invite everyone to join our social media channels and be part of the conversation there.
Perfect. Eitan, thank you so much.
Thank you.
Bye-bye.
It was a pleasure. Thank you.
Thank you.
Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.